Imagine looking at a company that practically overnight swung from generating just billions of dollars in pure profit to, burning through billions in losses.
Yeah.
Like a company that right when the broader market kind of assumes its glory days are completely in the rearview mirror, it suddenly spikes 177% in a single day of trading.
Right, which is just unheard of for a company of that size.
Exactly. And to top it all off, you have these highly resourced Wall Street analysts looking at the exact same clinical data and the exact same financial filings, and
Yeah.
yet they are fundamentally, like almost violently divided on what the entire operation is actually worth.
Yeah, it really is the ultimate test case in how the market prices the promise of future science against the
Yeah.
harsh reality of current cash burn.
Yeah.
You have these massive windfalls, these sudden crashes, and just a complete breakdown of any kind of rational consensus.
Right. Well, welcome to a brand new deep dive. We have a massive stack of financial data, charts, and technical reports on Moderna Inc., ticker symbol mRNA. And this specific deep dive was highly requested by the audience over at the YouTube channel Stoxfeed.
Shout out to Stoxfeed.
Yeah, they wanted us to look under the hood of this extreme volatility. And just to set the table for everyone listening, our goal today isn't to tell you whether to buy or short this stock. We are acting purely as translators for a highly complex market event as it stands today, which is Tuesday, August 25, 2026.
Right, exactly.
We're just unpacking the objective data, laying out the arguments from both sides, and giving you a neutral report on the mechanics of what is actually happening.
And that neutrality is so vital when you're looking at biotech because, man, the emotions run so high.
Oh, absolutely.
We're looking at the architecture of a company in a profound state of transition, and we're going to explain the mechanisms driving these just wild swings in valuation.
So let's jump right into the immediate whiplash. We have to start with the catalyst that put Moderna back on the front page of every financial terminal this week.
Yeah, the big news.
Right. So on August 19th, 2026, Moderna released phase 3 trial data for an individualized melanoma cancer vaccine, which they developed alongside Merck's blockbuster drug, Keytruda.
Yeah, and to understand the sheer scale of the market's reaction here, you really have to look at the mechanism of the science itself.
Yeah.
Because when people hear the word vaccine, they usually think of, like a preventative shot for a virus.
Like the flu shot.
Exactly. But this is entirely different. This is an individualized neoantigen therapy. So what they do is they take a physical biopsy of a specific patient's tumor.
Okay.
And they sequence its DNA to identify the unique mutations, the neoantigens, that are specific only to that one person's cancer.
So they are essentially building custom software for one specific human being.
That's a great way to put it. Yeah, they code those specific mutations into mRNA, and then they inject it back into the patient. And the mRNA instructs the patient's own cells to produce those exact mutant proteins.
Wait, so they're making the body produce parts of the cancer?
Well, just the specific proteins, which acts like a massive red flag for the immune system. Because, cancer is notoriously good at cloaking itself. It hides from the body's natural defenses.
Right.
So this therapy strips away the cloak and trains the body's T cells to just hunt down those specific cancer cells. And the phase 3 data proving that this concept actually works at scale was, it was incredibly positive.
It was so positive that the stock didn't just pop. It multiplied.
Yeah.
In a matter of hours, it spiked 177% intraday. It briefly hit $174.38. They traded 185.1 million shares in a single session.
Which is insane.
Yeah, that's 18 times its average daily volume. They added over $40 billion in market value before lunch.
Just staggering numbers.
Right. And the trendline momentum score currently sits at a scorching 85 out of 100, which technical traders classify as highly bullish, and it pushed the stock above all 8 of its short-term and long-term moving averages. The 52-week range is now this massive canyon, stretching from a low of $22.28 all the way up to that $176.66 high.
And see, that kind of momentum creates a feedback loop.
How do you mean?
Well, algorithmic traders, the computer models, they detect the volume and the price action, which triggers automatic buying programs, which in turn drives the price even higher, and then that draws in the retail momentum traders.
Right.
So it becomes a self-fulfilling prophecy for that specific trading session.
Right. It's like a band known for exactly one massive hit song suddenly dropping a surprise album that critics love. The crowd just goes wild.
Yeah.
And here's where it gets really interesting. If the data was so good, Why did the stock immediately suffer a 25% pullback the very next day, wiping out roughly $18 billion in market value just as fast as it appeared?
Yeah, the hangover.
Yeah, I mean, when you realize their 1-month beta is sitting at 2.65, you see exactly why this happened. This stock isn't just moving with the broader market, it's practically vibrating. It's swinging more than 2.5 times harder than the S&P 500 on every single piece of news.
Well, you have to think about the psychology of the people holding the stock, right?
Mm.
Investors who bought in at that $22 low earlier in the year were suddenly staring at life-changing lottery ticket gains.
Oh, for sure.
So taking chips off the table in that scenario, that's just human nature. But that intense volatility, that 2.65 beta you mentioned, it's a symptom of a much larger underlying anxiety about the company's foundation.
Which brings us to the fundamental reality that's sort of lurking beneath that shiny new cancer data. The price spike is masking a pretty brutal situation on the balance sheet.
Yeah, it really is.
If we look at Trendline's durability score, which measures long-term financial health, consistent growth, and cash flow generation, Moderna scores an 11 out of 100.
Ouch.
Yeah, that is firmly in the low financial strength category.
Because the whiplash on the income statement is historic. I mean, in fiscal year 2022, fueled almost entirely by global demand for the COVID-19 vaccine, Moderna generated a net income of over $8.3 billion.
Right.
But you fast forward to the trailing 12 months leading up to today, and they have recorded a net loss of $3.15 billion.
Wow.
Yeah. Revenues have crashed, down 39.9% year over year, and the operating profit margin has completely collapsed to a negative 159.9%.
Okay, let's put that operating margin into plain English for a second. A negative 159% operating margin means that for every single dollar of revenue Moderna brings in the door right now, it costs them more than $2.50 just to keep the lights on and run the business.
Exactly. And the physical reality of that metric is a massive infrastructure hangover.
What do you mean by infrastructure hangover?
Well, during the pandemic, they had to build out this massive global supply chain, right?
Mhm.
They had to hire thousands of personnel, secure manufacturing facilities capable of producing billions of doses of vaccine.
Oh, right. They scaled up for the entire world.
Exactly. And you cannot simply flip a switch and turn those fixed costs off when the pandemic ends. They are stuck paying for an industrial machine that was built for a level of demand that just no longer exists in reality.
Okay, but let's unpack this a bit. I'm looking at their balance sheet, and I'm honestly kind of confused by this low durability rating and the elevated bankruptcy flags. I see their Altman Z-score, which measures the likelihood of bankruptcy, is sitting at 2.62, and anything below 3.0 traditionally flags elevated risk.
Oh,
Yet the data shows they still have over $5.1 billion in cash and equivalents. Their net cash position is over $5.6 billion.
mm-hmm.
That's $14.08 per share in pure liquid cash. If I have $5 billion sitting in my bank account, I'm not worried about the lights going out tomorrow, you know?
Well, you aren't worried if you have $5 billion in the bank, sure. But you would be if your lifestyle suddenly costs you over $1 billion a year and you just lost your main source of income. See, the Altman Z-score and that 11 out of 100 durability score, they aren't predicting that Moderna is going to file for Chapter 11 bankruptcy on Monday morning. They're sounding the alarm on the trajectory of that cash cushion.
So the burn rate is eroding the floor.
Exactly. The cash from operating activity over the trailing 12 months is a negative $1.07 billion. The free cash flow is negative $1.24 billion. So that $5 billion cushion is simply the leftover treasure from the COVID era, and it is deflating rapidly.
Right.
The financial metrics are flagging that the current business model is structurally broken. They're surviving purely by draining their past savings to fund their current research.
Man. And just as we map out how fast they are draining those savings, we uncover a brand new massive expense that is hitting that exact same cash cushion right now.
Yep, the lawsuit.
Yes, this brings us to the legal shadow hanging over the company. In late August 2026, practically in the shadow of all that melanoma vaccine hype, Moderna finalized a patent settlement with Genevant Sciences and Arbutus Biopharma.
Right. And it's important to note, this dispute has nothing to do with the new cancer research. This is a ghost from their very first commercial success.
Right.
The entire lawsuit centers around lipid nanoparticle delivery technology, which is commonly referred to as LNP.
Okay, let's explain what that actually is, because it is fundamental to how mRNA actually works, right? Because mRNA is incredibly fragile.
Very fragile.
If you just inject raw mRNA into the human bloodstream, The body's enzymes will basically recognize it as foreign debris and just tear it apart in seconds.
Exactly. So think of it this way. The mRNA is just the letter containing the biological instructions.
Okay.
But the lipid nanoparticle is the envelope. It's this microscopic bubble of fat that protects the fragile mRNA, carries it safely through the bloodstream, and allows it to actually slip through the cellular membrane so the instructions can be read by the body.
Gotcha. So without the envelope, the letter gets destroyed in the mail?
That's exactly it. And Genevant and Arbutus essentially took Moderna to court, claiming that they owned the patent on those specific envelopes. They argued that Moderna infringed on their intellectual property to create Spikevax, which was the original COVID-19 vaccine.
And the cost to settle this dispute is just staggering.
Oh, yeah.
The upfront payment, which hits the books immediately, is $950 million. But that's only the beginning, right? There is a contingent payout of up to $1.3 billion additional dollars, and all of that is resting on an upcoming appellate court ruling regarding government contract immunity under something called Section 1498.
Yeah, Section 1498 is this really fascinating piece of legal architecture. It's essentially an eminent domain law for patents, and it was originally designed for wartime.
Really? Wartime?
Yeah, it dictates that if a company infringes on a patent while manufacturing something explicitly for the U.S. government, like, say, a pandemic vaccine requested during a national emergency,
Right.
the patent holder is actually required to sue the U.S. government for damages, not the manufacturer.
Oh, so the manufacturer gets a legal shield because they were acting on federal orders.
Precisely. And Moderna has been arguing that Section 1498 protects them from a massive portion of these LNP infringement claims. But if the appellate court rules against them and strips away that shield, Moderna is fully on the hook for that contingent payout.
Wow.
Which brings the total potential cost of this settlement to $2.25 billion.
Wait, so why in the world would a company that's already burning over $1 billion a year in free cash flow agree to hand over almost half of its remaining cash pile for technology used in a product where the commercial demand has already collapsed? I mean, it looks like setting money on fire.
It looks entirely backwards, I agree, until you look at their future pipeline.
Okay.
Because the settlement doesn't just pay for the past. It buys them a global, non-exclusive LNP license for all future infectious disease products.
Ah, I see.
So they're paying a massive premium to just clear the decks because they have 25 different mRNA development candidates in clinical studies right now, targeting everything from, respiratory viruses to rare genetic diseases.
Right, right.
They just cannot afford to have a multi-billion-dollar intellectual property lawsuit hanging over every single new drug they try to bring to trial.
So it's like a necessary extraction of a legal tumor, but it still takes a catastrophic bite out of their financial runway?
Exactly.
Which leads us to maybe the most confusing dynamic for the Stoxfeed audience trying to analyze this security. If the company is losing billions a year in operations, facing a $2.25 billion legal bill, and relying on a shrinking savings account to keep the lights on, how does the stock market justify assigning it a $62 billion valuation?
Well, Trendline's valuation score gives it an 8 out of 100, so it categorizes it firmly as an expensive valuation.
Right.
The price-to-earnings ratio is non-existent because, well, they don't produce earnings. Right. And the price-to-sales ratio is currently sitting at 27.7 times.
And a price to sales of 27.7 means investors are paying almost $28 for every $1 of rapidly shrinking revenue the company generates.
Right, and that multiple proves that institutional investors aren't valuing the current revenue at all. They're entirely focused on modeling the future.
Yeah.
And this dynamic has created this all-out war among Wall Street analysts. I mean, they are looking at the exact same financial filings and coming up with wildly different realities.
Yeah, the official analyst consensus rating is a whole D, but the underlying target prices are pure chaos. The average price target is $91.39, which would represent a nearly 42% downside from the current trading price. But individual firms are separated by these massive gulfs. You have Morgan Stanley predicting the stock will crash down to $89. But then in the very same week, you have Bank of America Securities setting a target of $170. How do teams of professional researchers, building these complex discounted cash flow models land $80 apart on the exact same company?
It comes down to how they adjust their models based on the probability of success for that 25-drug pipeline.
Okay.
When you value a biotech company, you assign a percentage likelihood that a phase 2 or phase 3 trial will actually reach commercialization, and you model that future revenue accordingly.
Right.
So Bank of America looks at the phase 3 melanoma data and sees undeniable proof of concept. They are assigning a really high probability that this is the dawn of a massive oncology franchise that will generate tens of billions of dollars in the 2030s.
Oh, I see.
Yeah, so they're willing to ignore the immediate cash burn because they believe the future payday justifies the current premium.
So Bank of America is looking at the science, but Morgan Stanley is clearly weighting the model differently.
Very differently. Morgan Stanley is focusing on the timeline because the cancer data is scientifically impressive, sure, but the regulatory process takes years, commercialization takes years, building a sales force takes years, and at a burn rate of over $1 billion annually, compounded by that potential $2 billion legal settlement, Morgan Stanley's model suggests the cash runway will evaporate before that oncology empire is ever fully built. So Bank of America is valuing the ceiling of the science, while Morgan Stanley is valuing the floor of the balance sheet.
Man, with Wall Street fractured into two entirely different camps like that, the next logical step is to follow the money, right? Who is actually holding the bag right now? Who owns the majority of this $62 billion market cap?
Well, ownership data shows that retail investors and mutual funds hold the vast majority of the float. Mutual funds alone account for 83.3% of the outstanding shares.
Wow.
And when you zoom out to institutional investors as a broader category, they hold over 91%. So Main Street pension funds and large asset managers are heavily exposed here.
Okay, but what about the people inside the building? What are the executives doing with their own money?
That is where it gets really interesting. Insider holding is sitting at a microscopic 2.7%. And when we pull the recent Form 4 filings from the SEC, the trading activity of CEO Stéphane Pancel tells a very specific story.
Okay.
He was selling hundreds of thousands of shares just weeks ago, specifically on August 5, 2026.
Wait, let me stop you there, because the timeline is critical. He was selling massive blocks of stock on August 5th. The phase 3 melanoma data, that massive catalyst that spiked the stock 177%, was released to the public on August 19th. That is exactly 2 weeks later.
Yep. The filings show he was exercising options priced at $19.15 and hundreds of thousands of options priced at literally $0, and then immediately unloading those shares onto the open market at prices ranging between $56.21 and $58.79.
I mean, think about the irony of that sequence. The CEO of the company, the single person on Earth who has the most intimate knowledge of the clinical pipeline and the internal trial data, exercises options at $0 and takes profits in the mid-$50 range, completely missing out on the vertical spike to $174 just 2 weeks later.
Right.
Doesn't that fundamentally prove just how unpredictable biotech binary events actually are? Like, even the executives running the trials cannot accurately time the market's reaction.
It really does. It perfectly illustrates the sheer volatility of the sector. You can believe in the long-term validity of the science, but you can never be certain exactly when a clinical endpoint will be met or how aggressively the algorithmic traders are going to bid up the news.
Yeah.
And honestly, that insider selling behavior also explains why Trendline's overall checklist score for Moderna shows a failing 47.4% pass rate.
So the company is failing the majority of its own fundamental checks.
Yeah, because the algorithm looks for long-term operational stability. It screens for, consistent profit growth, stable insider ownership, and valuation affordability. And Moderna fails spectacularly on almost all of those fundamental fronts.
Right.
The insiders are liquidating, the valuation multiples are stretched to extremes, and the net income has inverted into massive losses. The only metrics keeping that overall score anywhere near 50% are the short-term technical indicators, the moving averages and momentum oscillators that were triggered by that sudden influx of volume surrounding the melanoma news.
Well, we have to bring all of these threads together for the Stoxfeed audience. We were asked to unpack the anatomy of this volatility, and the data paints a picture of a stock defined by extreme, almost violent contradictions.
Yeah, it really is a company living in two different realities simultaneously.
You have this incredible short-term momentum, a technical score of 85, driven by undeniable, potentially world-changing scientific breakthroughs in personalized cancer treatment.
Right.
But that future promise is heavily chained to a terrible fundamental durability score of 11 and an expensive valuation score of 8. It's like an organization trying to build the future of medicine while dragging the massive financial infrastructure and the multi-billion-dollar legal baggage of the fading COVID era behind it.
Exactly. The data dictates that we view this not as a simple growth stock, but as a really complex transition play. The battlefield is clearly drawn between the bulls who believe the mRNA pipeline will inevitably replace the lost pandemic revenues and the bears who see a cash burn rate that will force the company to dilute shareholders before they ever reach the finish line.
And hopefully this deep dive gives you the mechanical context you need to understand the conflicting headlines you are seeing today.
Yeah, but there is one final variable that isn't explicitly modeled in the financial projections, but it's kind of hiding in plain sight within the data we unpack today.
Ooh, all right, let's hear it.
We spent a lot of time breaking down that $2.25 billion settlement with Genevant and Arbutus. That massive legal bill was the cost of securing the lipid nanoparticle technology required for their first big commercial success. But as we established, mRNA is inherently fragile. It will always require a complex delivery mechanism to reach the cell.
Oh, I see where you're going with this.
Yeah, if the underlying delivery architecture of mRNA is this legally contentious and this incredibly expensive to resolve in court, how many of Moderna's 25 future pipeline candidates might suddenly find themselves facing entirely new intellectual property, hurdles the exact moment they show commercial promise? Are they innovating, or are they just paving the way for the next massive lawsuit?
Man, if a 177% spike is the sound of a company proving their science works, a multi-billion-dollar patent lawsuit might just be the sound of the rest of the industry showing up to claim all the royalties.
Exactly.
That is a heavy, lingering thought to leave on. Thank you to everyone at Stoxfeed for requesting this analysis, and thank you all for joining us on this deep dive. Keep questioning the data, look past the headlines, and we will catch you on the next one.